Welcome to JM Financial Mutual Fund's Equity Outlook. In this short video, we would take a look at how different economic and market factors behaved in the recent past, but also look at our view on the Indian equity markets, which may in turn impact the positioning of our schemes. The Nifty index was down by 0.3% for the month ended November 2024. The Nifty Midcap 150 index was down by minus 0.1%, whereas the Nifty Smallcap 250 index was down by minus 0.2% in November 2024. Sector-wise, Nifty IT 6.8%, Nifty Realty 2.1%, and Nifty PSU Banks 1.3% were the top-performing indices, whereas Nifty Energy minus 4.6%, Nifty Metal minus 3.1%, and Nifty Pharma minus 2.2% were the laggards. Global indices ended the month of November 2024 on a positive note. Dow Jones was up 7.5%, Nasdaq was up by 6.2%, while the Financial Times Stock Exchange 100 was up by 2.2%. The India Volatility Index, VIX, saw a decline in November 2024. It was at 14.43 compared to 15.55 in the month of October 2024, down by 7.0%. The Chicago Board Options Exchange's CBOE Volatility Index, CBOE VIX, saw a decline in the month of November 2024 and was at 13.51 as against 23.16 on the month of October 2024, down by 41.7%. Foreign Institutional Investor, FII, were net sellers for the month of November 2024. Net FII outflows were rupees 22,602 crores. Domestic Institutional Investor DII bought stocks worth rupees 44,484 crores, whereas MFs were net buyers worth rupees 35,633 crores. Nifty 50 forward PE trading greater than 1 standard deviation over the mean PE. Nifty Midcap 100 is trading near 2 standard deviation above the mean forward PE. Markets nudged up a little in November 2024, led by IT, consumer durables and real estate. Lagging sectors were utilities, PSUs, and metals. Some defensive sectors also lagged, such as pharma and auto. There was a shift away from most emerging markets. Almost all emerging markets other than China declined during November 2024. In contrast, all developed markets other than Japan appreciated during the month. The key issues for the market are economy slowdown and earnings slowdown, government expenditure revival, inflation and central bank action, recovery in consumption and supply of paper. Is the economy slowdown temporary? India's GDP print came in lower than expectations at 5.4%, led mainly by a slowdown in government expenditure and capital formation. Manufacturing activity growth declined to a mere 2.2% year-over-year, as compared to 7.0% in the previous quarter and 14.3% in the previous year. Some of the slowdown can be attributed to weaker exports. GDP growth for Quarter 2, financial year 2025, stood at a mere 5.4%, substantially lower than 6.7% recorded in Quarter 1, financial year 2025, and 8.1% in Quarter 2, financial year 2024. Though some moderation was expected, with high-frequency indicators pointing towards slowdown in both supply and demand-side levers, the reading came in way below the general market consensus of 6.5%. Notably, private consumption expenditure, which accounts for 56% of the GDP basket, grew by 6.0% in Quarter 2, financial year 2025, lower than 7.5% in Quarter 1, financial year 2025, but substantially higher than 2.6% in Quarter 2, financial year 2024. Recovery in rural demand could likely have supported the private consumption in Quarter 2, financial year 2025. Growth momentum in gross fixed capital formation has slowed with incrementally lower growth seen in the last 4 quarters. On the other hand, government consumption expenditure witnessed a decent growth of 4.4% after observing lackluster growth-degrowth in the past 3 quarters. Central government's capital expenditure in October 2024 stood at Rs 51,579 crore, a decline of 8.4% year-on-year. On a fiscal year-to-date (FYTD) basis, April 2024 to October 2024, capital expenditure has contracted by 14.7% compared to a growth of 33.7% in the corresponding period of the previous financial year. Key ministries, which accounted for 90% of the budgeted capex for FY 2025, noted a year-on-year decline, except for Ministry of Housing and Urban Affairs. For the remaining of the current fiscal year, the government needs to spend about Rs 6,04,000 crore, which translates to a monthly spend rate of Rs 1,29,000 crore. This looks like a steep run rate, and there is a possibility that the actual capex could turn out to be lower than the budget estimate. We expect economy to recover sequentially as the government budgets get allocated and spent. Consumption is expected to recover as rural incomes improve on better rainfall. Slower economy is equal to slower earnings is equal to range-bound market. Our basic premise is that given the current high valuations and rapidly weakening earnings growth, market performance could be range-bound. However, individual stocks may show significant outperformance or underperformance based on market perception of earnings and earnings momentum. Lower liquidity and volumes in the market may help large caps outperform, but in general, we believe return generation will be on the basis of tactical trades as well as having a diversified portfolio to prevent significant underperformance or outperformance. Corporate India's PAT, 477 common companies in BSE 500, in Quarter 2 FY25 grew by a mere 0.6%, substantially lower than a strong growth of 42.6% recorded in Quarter 2 FY24. India's inflation is primarily due to food inflation. However, in recent times, the central bank has alluded to maintaining current interest rates at 6% as retail inflation is still high at 6.5%. Yet high interest rates have slowed down credit growth and private capex. This conundrum needs to be solved as we risk high interest rates slowing down the economy further. Apart from this, America's growth is pulling out funds from emerging markets, and this could impact our forex reserves as well and tighten liquidity. The slowdown in corporate earnings and GDP has been sharper than expected. We expect consumption to gradually recover as rural income improve as also government expenditure. We are still defensive in our allocation as we anticipate market volatility to continue. Policy action has been slower than expectations in infrastructure, power and railways. Robust domestic inflows into equity markets and continued outflows by foreign portfolio investments, as also large capital raised through follow-on public offers and initial public offerings, acts as a brake to secondary market appreciation. We expect this to continue until FPIs start investing back into emerging markets. With key domestic state elections behind, we expect the government policy action to resume. There has been some slowdown in government expenditure and payment cycle, which needs to reverse. Further, there is an active discussion between the RBI and the government as to how to revive growth. This may involve lower interest rates and/or lower reserve ratios and some currency depreciation as well. India's capacity creation continues to lag demand potential, and hence we are confident that growth is delayed but not unviable. But if prompt policy action is not taken, the slowdown could prolong and impact sentiments. We also need to await key policy decisions post the new president coming in January in the United States of America. Key sectors exposed to this are Indian IT and pharma sectors. There could be some volatility here as well. Foreign direct investments continues to grow, indicating that India is gaining credibility as a manufacturing destination, On-ground confidence among companies we have met is still high, and most companies are in the process of increasing capacities. We believe that this sets the stage for the next leg of earnings growth. From an investment perspective, we expect returns to remain modest over the next few quarters. A range-bound market cannot be ruled out, and we expect SIPs to help during this period. Structurally, India continues to remain well poised to grow faster than other countries and report strong earnings growth. Hence, corrections and range-bound markets could be used as an opportunity to build our portfolios. Bitcoin has outperformed all asset classes, was up 158.1% in the last 1 year. Gold was up 29.8%, silver up 21.2%, whereas Brent crude was down by 11.9%. The mid-cap and small-cap companies outperformed the large-cap companies over the last 1 year. Nifty 50 index was up by 19.9%, whereas Nifty Midcap 150 index and Nifty Small-Cap index was up by 31.0% and 33.7% respectively over the last 1 year. Indian markets have underperformed US markets on 1-year basis and outperformed on 5-year basis.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.